Now, SA narrowly escaped a technical recession in 2023's fourth quarter GDP figure, with the figures showing only a modest growth rate. Now, despite ongoing efforts to stabilize the economy, the outlook for the country seems bleak. Will SA manage to steer clear of a recession, or are we on the brink of another economic downturn? And joining us to provide insight is Chief Economist at economist Isaah Mhlanga. Thank you so much for your time, Isaah. I don't know if I would call that growth that we saw in the fourth quarter modest, because it was basically close to zero. So, of course, ever since we averted this technical recession in 2023, there have been talks of other types of recession, others coming in to say that we are in a GDP per capita recession, others saying no, we are actually, the gross national income per capita has slowed. Which numbers should we be looking at here? And does any data point to any kind of recession?
Thanks for having me. I think it depends on what questions you want to answer. If you're looking from an overall economic performance perspective, a 0.1 percentage growth is really nothing to write home about. If you just consider also in the last quarter, the previous quarter, which is the third quarter of 2023, the economy contracted by 0.2 percentage points. Looked at more broadly, it just means economic growth was stagnant in the second half of last year. Again, you have to also consider the fact that the economy is very complex, it's difficult to measure. Economic statistics, particularly for GDP, is subject to revisions quite often, which is not a South Africa specific issue, it's a global issue. So to really make a big check out from a 0.1% growth on a quarter doesn't really make sense. The point is the economy stagnated. But if you're to look at, trying to measure the well-being of South Africans, then you would look at GDP per capita growth. You have to consider that population growth is north of 1.5%. So if the economy is growing less than that, it means South Africans are getting poorer. The economy is not generating enough to take care of the needs of South Africans. That's what it means in broad terms.
So basically, as much as we're not in a recession when you look at the broader data, but households are actually in a recession at this point.
Household consumption also expanded by 0.2 percentage points, following a contraction of 0.2 in the previous quarter, that is the third quarter of 2023. More broadly, consumers are under strain. You can see it as far as the consumption line are concerned. But you can also expect that because interest rates have been increasing for quite some time, mortgage payments have been quite, increasing for quite some time. But also in the behavior of consumer, you also tend to see a different dynamic where consumption of the big ticket items, furniture, motor vehicle sales has been reducing significantly. You see a shift in terms of those big ticket items where we are seeing the consumer reducing the purchases. And then you tend to see what we typically name the lipstick effect. Clothing and footwear has been increasing significantly, which is what you tend to do when you can't buy the big ticket item as well, just look good. Essentially, that's what we've been seeing in the data. But we can also look at other aspects. If you look at gross fixed capital formation, it has contracted in the fourth quarter of 2023 relative to what we saw in the third quarter, but the contraction has been less severe compared to what we saw in the third quarter. But all said, from a sectoral perspective, agriculture is in a technical recession. It contracted in both the third quarter and the fourth quarter. You look at another sector, construction is in a technical recession. It has contracted again fourth quarter and in the third quarter. Trade, catering, and accommodation is also in a technical recession. So 3 of the major 10 subsectors of the economy have been contracting for 2 consecutive quarters, which then lends itself to low economic growth overall for the economy, in the fourth quarter of last year.
And actually, as we're talking about that sectoral focus, looking at previous recessions, have there been sectors that have contracted so much that they give way to broader economic growth and recession, and also just maybe looking at how the economic contribution has shifted, where now we have the tertiary sector contributing a lot more to the economy. Could we maybe be insulated because of that at this point?
Indeed, we have to look at the shares contributions in the economy of each particular sector. Even though you saw a significant contraction in the agricultural sector, 9.7% on a quarter-on-quarter basis, it's still a very small sector overall, under about 2.7% of the economy. And then if you look at construction, again, it's a small sector of the economy. Its contraction in the fourth quarter was 1.4%. Trade and catering is slightly larger, but its contraction as well is 2.9%. But if you look relative to the rest of the sectors, they still outweigh, in terms of their percentage contribution in the economy, they outweigh the sectors that contracted. Hence, we ended up with a marginal, a positive number of 0.1%. But we shouldn't really concentrate on the 0.1. Growth was stagnant. Some sectors that contracted, they were fully offset by sectors that expanded.
Isaiah, I know that in the US, usually, investors will point to alarm bells that ring in the bond market, that this signals a recession that's coming up ahead. So they'll look at the bond yield curve inversions between the 10-year and 2-year bond curves. And I'm wondering if any data could maybe point to alarm bells that are ringing in terms of a recession or further economic pressure in South Africa.
From where we are, our bond yields are quite steep. So the yield curve is very steep, which means long-term yields are much higher compared to short-term yields. There is no indication of a recession as far as we are concerned from what we, from our forecasts. For this year, we actually think economic growth is going to improve relative to what we saw last year. So we're expecting about 1.3% growth for the economy this year, which is almost a doubling in terms of economic growth from what you had, in the 0.6% overall growth for 2023. Yeah. The impact of load shedding is becoming less intensive in the economy because of the investments from the private sector into own energy generations. And that is going to, drive economic growth better this year relative to last year. So all in all, perhaps the worst is behind us, and we're seeing some improvement going forward because of the reforms that are taking place in the energy sector. But we also expect some improvement as far as our logistics are concerned going forward, which means better economic prospects than what we have seen in 2023.
Well, actually, I mean, just as we're talking about the kind of more optimism for 2024 that we have from that 0.6% growth in 2023 to maybe around 1% or maybe slightly higher than 1% in 2024, does that move then, filter through to actual households, or could it still be too insignificant to actually be felt in real incomes?
Look, it will be felt in real income, but it's not significant enough to reverse the increase in unemployment that we have seen, or the high unemployment rate that we have seen. For us to reduce unemployment rate on a sustained basis, we need economic growth of about 3% on average on an annual basis and over a number of years. Then we can see unemployment rates decline on a sustained basis. But all that said, if the economy continues to pick up closer to 2%, we will see the impact on a moderating unemployment rate, which is going to be felt in a real sense, by people on the street.
Yeah. In terms of, talking about real incomes, because that's also another thing where salaries and wages just have not kept up with the level of inflation that we have seen over the last few years. Will this just keep on being a rat race where we just never catch up until a certain amount of economic growth comes to the fore?
Because real income is determined by two components, the nominal wage income, and then where inflation is. As we project inflation to moderate for this year, we will then expect real incomes to increase. If you just think about where our expectations are for inflation, just around 5% or so, next year moderating to 4.6%, and then the year after 4.5%, which means in real terms, incomes will get a boost a bit relative to where we're coming from, where we had inflation significantly high and much higher than the 6% upper target.
Yeah. And of course, our growth outlook also depends on the fiscal positioning of the country. And we know, obviously, the relief that we did get by Treasury deciding to draw down from the FECRA account. And I'm wondering also just, how long that sigh of relief is, or how deep it is, and how sustainable it is for it to filter through to actual economic growth.
Look, the use of the GFECRA does help as far as reducing the quantum of debt and therefore our debt servicing costs. It does help quite significantly, but it's not going to be something that we can sustain. Remember, the GFECRA account accumulated over nearly 2 decades. Yeah. And we've never tapped into it like many other countries do on an annual basis, which is why the 150 billion rand is such a significant quantum this time around. But going forward, what is going to be available from potential revaluation profits is going to be significantly a smaller quantum of what is going to be available for Treasury. So it's not something that is going to be a sustainable source of funding or source of capital that we can use to reduce our debt servicing cost and our debt stock. That is not sustainable. It's not something that we should bank on. But that is maybe for this particular time around, it has been useful. It's going to help to reduce our debt servicing costs, but some 30 billion rand, which is quite a significant figure. However, going forward, it's going to be less significant.
Yeah. Isaah, you spoke about obviously the economic growth that we are expecting for 2024 that will be higher than 2023. And of course, that hinges on, load shedding getting better and also sorting out the logistics challenges that we have. There was a sense for a long time, that load shedding was denied until it was too late, where even now you saw with our logistics issues, where now that hole has been dug so deep that, the risk has now, come to the same level as the risk that we do experience with load shedding. Is there anything that could blindside the economic growth momentum that we are seeing and that we will see, something that maybe many of us aren't paying attention to at this point?
Look, what comes to mind are the water issues. I'm sure we are all aware in terms of the water issues in KZN, in Port Elizabeth. We have been aware of the water issues in Tshwane, and now we have critically aware of the water issues in Joburg. And that will be a constraint for growth overall. We do also have some concerns as far as the external environment is concerned. China's economic prospects matter from a commodity price perspective, and we're still a country that depends in terms of the exports on commodity exports, and which means moderation in China's economic growth would also moderate external demand for those commodities. So we have some concerns as far as the external environment is concerned. But again, we are operating in a geopolitically charged world. For this year, we have 70 plus countries that are going to elections, which means they are going to be inwardly looking, and therefore a potential for outward bound foreign direct investment, which will be geared towards the likes of South Africa, is going to be less relative to other years. We tend to see a slowdown in fixed investment, particularly from offshore, when we have general elections, and that is going to be something that we see at least for this year. There is an embedded policy risk that prevents rapid growth in foreign direct investment or gross fixed capital formation in general. those are some of the factors that would, dampen the pace of economic growth that we should expect.
All right. Well, thank you so much for your time and for your insights today, Isaah, on what we should look out for that could impede that growth momentum, but also some of the green shoots that we are seeing in the economy, particularly on the energy and logistics side. And of course, quite a sigh of relief that there are no signs of a technical recession at this point. That was Chief Economist at RMB, Isaah Mhlanga.